Last week we spoke about the problems that especially the US banks are facing nowadays. We had a lot of questions because we first talked about the problems, but we also spoke a little bit about the solutions for you and me as a private investor and with people with cash money on their bank account with their bank.
Absolutely.
And we also said, okay, the problem in the US is maybe a little bit bigger than in Europe, but the problem is also in Europe. A lot of people reached out to us and said, okay, but please help us a little bit more with the solutions.
Yeah. How do we do it?
Yeah.
What do we buy? What do we not buy? Do we pick up this or that? And of course, we don't advise in that specific. We don't say,
We
you
help.
have to buy this.
No,
but
we
we
help, and
try
we-
to inspire, try to explain.
Yeah, and to educate, because we have, and I want to say it again, because we have online courses, and then we have also courses about bonds. And in the past, nobody did it last year, but now everybody wants to have, not everybody, but wants to have the bond course, because in the bond course we explain through videos, we're interactive with questions and answers. We explain how the bond market works, and you should know that if you want to do something in bonds. And what we want to do now is bonds. You have all kind of different bonds. You look at a bond in your screen or in the newspaper and think, oh, that's interesting. But you have to know what are the rules, what are the characteristics of the bonds.
Yeah.
And you can't see that from your screen.
No.
And Martin will explain.
Yeah, we'll give you a very nice example on one. It's an FRN note. So FRN already has to give you some sort of signal. Hey, this is not a fixed interest. Stands for floating rate note, and it's a bond that was given out by Casino Guichard.
Yeah, but the first that you are.
Why are you interrupting?
No, because people should know that you will give a bad example.
Yeah. Oh, yeah. Of course.
Yeah.
But I was going to say that.
Okay.
I'm going to say that.
Normally, I always have the
You
bad examples.
give the good examples.
Yeah,
And I give the bad
today, yeah.
Now, but what I want to show you here is that this is a randomly picked bond, right? So I didn't look for it. I just looked at FRN and so for a floating rate note, because then I know there is something with the interest rate that you get paid out. And in this case, the first one that popped into my screen was the Casino Guichard 2000.
Casino Royale?
Casino Royale, yeah, well, sort of like. Which because you can literally bet on it whether it goes well or not, but that I would not recommend it to you.
No,
so this is a bond that was given out 750 million in 2013, and the first 6 years they were paying out nicely 4.87% fixed. You see the price, of course, in the beginning was okay because the interest rates were more or less what they are now, and then they interest rates started going down. Of course, we had COVID and all that sort of thing. So Casino Guichard needed to convince the investors to keep their money in the bond, and therefore the price went down, and so the interest rate went up in this case. So the interest rate at this moment is 5-year swap plus 3.819%, so that comes down to 3.99, almost 4%. But the price of the bond is 10%. So yeah, if you calculate that back, you get 40 euros on an investment of 100. It's insane. So you might think, oh, that's interesting, but you really need, when you open the prospectus, which I did for you guys, the first thing that came up was deeply subordinated hybrid vehicle bonds and all different sort of language. So then, of course, you already need to take one step back. Do I understand what it is saying here? So, and this is really, really important when you buy bonds, especially when it says FRN or it says PERP, perpetual, then that's what happened now with the COCOs and with the AT1 bonds. The people just lost, they said Credit Suisse people, investors, they lost 16 billion, the bondholders. Shareholders were left with about 50-60 cents, but the bondholders lost all their money. And that is something also what can happen here with a deeply subordinated bond. You're in the last position when something happens with the company. So I definitely would not recommend you to buy something like this, but what I do I'm not giving any recommendations, but I do think you could consider as an alternative for cash is what Kaspar is going to tell us now.
Yeah, so again, if you want to invest in bonds, don't only look at the screen, and if you get a 40%...
and today is the birthday of my grandmother. She turns, I think, 94, and I was just thinking about this, what you going to say, I would even dare to say to my grandmother.
Yeah?
Yeah, why not?
Okay, that was it. Thank you for watching.
Congratulations, Grandma.
So, We spoke where the problems are is that the banks, they had to buy because of all the money, they had to buy the most risk-averse products in the world, triple A investments, so bonds from triple A countries like the Netherlands, like France. They bought them at that time. There was no interest rate, so they bought with coupons of 0 or 0 point something percent. Interest rates went up 4% in 1 year, and the prices of those bonds collapsed because the duration of those bonds were 30, 40, or 50 years.
Correct.
So that's what we explained last week. So you buy a security. Is there a problem? Does the market think that country doesn't pay off their debt? Not at all. No credit risk in there. But because in the market you can get 4%. So if you buy a product with a duration of 30 years with 0 coupon or 0 point something coupon, that's worth much less.
Exactly.
So they went down with 50%.
Exactly.
The example that we are now going to give is exactly the same country that had giving out these bonds. The Netherlands. So don't buy long bonds because then you have a lot of risk from interest differences. In this case, last year again, the interest hikes. If you buy, for example, a bond from the Netherlands, triple A, with a duration from now until July 2025.
Yeah.
So that's 2 years and a couple of months, with a coupon of 0.25%. 0.25% only. So you get a coupon based on the 100 for 0.25%.
That's it.
But that bond is also trading lower than the 100.
Yes.
Not 50% lower, but a little bit more than 5% lower. It's trading at 94.93%.
Exactly.
So, is there a question mark that the Netherlands won't pay their debt to you in 2025? No, because it's still triple A, and I think it's one of the safest people that you can borrow your money to.
No, I totally agree with you.
So they will pay your money back, 99.99 something percent.
Yeah.
So what is then at that moment your result, your yield? Now, first of all, it's the coupon, the 0.25%.
Exactly.
But also you receive a little bit more than 5% because you pay it now for 94.93 and you will get 100 back, so that's 5.07%. So that together, if you so then you have to calculate what is that on a yearly basis. Then you have to calculate what is my average investment, because you invest now 95, but you get 100 back. So you have around invested on average 97.5%.
Exactly.
So if you calculate that, then you come out on a yearly yield of 2.6%.
2.6.
2.6% instead of 0 or a little bit on your account.
Yeah, the saving accounts still don't give anything.
But that's not the main thing. The main thing is the risk by having cash money on a bank, because there is a risk, and with one bank it's bigger than the other bank. But to help yourself, and if what we also said last week, if you have cash money and you don't trust the banks that much, don't move it to stocks, because then you go from an asset class risk averse to a high
Of course.
risk investment. But this now you because if the bank where you're banking goes bankrupt, the stocks and the bonds, you have them on your name, and they are always not within the bankruptcy. So that's the main important thing, how you can place your money safe, especially if you have more than 100,000 above a.
I totally agree with you.
So first of all, your money is safe, and secondly, you have more yield, 2.6%. They are traded the whole day around.
Narrow spreads.
So if you want to buy it now and you need the money in 1 or 2 months, you can always sell it, and probably you will sell it around the same.
Exactly.
And then it's also important to mention, if you sell it, for example, after half a year, you don't know exactly the price.
You sell a bit of the profit.
But you sell the interest, so you have that interest over that period.
Yeah.
So that's how you could solve your
your excess of cash.
Yeah. And please, if you buy bonds, know which bonds you are buying.
Yeah.
That's the moment.
And you can ask us.
And you can make baskets around it, and you can. There are different flavors for it, but this is how you should protect your money if you want to protect your money as we stated last week.
Correct. Thank you for watching. See you next week.
Thank you. Bye-bye.